Let me give you Schedule K-1, Form 1065, line by line instructions. Don't go anywhere. You're going to love today's conversation. I guarantee it. Welcome back, folks, to another edition of the Awesome Sturdy Kiwi Show. How are you today? I hope you are doing fantastic. I'm doing marvelous, if you were to ask me. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. In today's conversation, I'm going to do a Schedule K-1 1065 walkthrough, step by step. But before we get into the actual walkthrough, please understand, a Schedule K-1 is the official federal tax form that is used to report earnings and losses when there is an investment in a partnership. All right. And why do you need to file Schedule K-1? You want to report income. Anytime a beneficiary receives any income from a business, from a trust, or from any other partnership, they have to report Schedule K-1. And there are differences. There are different Schedule K-1s. So we have a Schedule K-1 Form 1065. We have Schedule K-1 Form 1120S. Those are the two. So those are two different versions of Schedule K-1s, both used to report income earned by businesses. And there is a third category of Schedule K-1. So we have Schedule K-1 Form 1041. And this, we have covered this on other shows, so we don't really have to cover it today. But in today's conversation, I'm covering Schedule K-1 Form 1065. Okay, this is used by businesses who are formed as partnerships. So while the partnership itself files a Form 1065, individual partners are also provided with the Schedule K-1 Form 1065 too, which reports individual shares of income, right? We have credits, deductions, or other various tax-related items. So this is their individual shares, very important. And Schedule K-1 Form 1120S is what S corporations use to file their taxes. So after filing a federal tax return, the corporation will also need to send every shareholder a Schedule K-1 Form 1020S. This is what will be used to claim individual income, credits, deductions, or other tax issues shareholders will be required to report. So this is just the bottom line here, okay? So you have to understand that the bottom line is there are different categories of Schedule K-1s. So here is on the screen right now, our completed Schedule K-1 Form 1065. So we have the first screenshot, and then the second screenshot. So now let's just break it down step by step. How did we get the numbers here? All right, I want you to look on the screen right now. Are you with me? So here we have the first part. So what you want to do is we actually fill this with hypothetical fictitious data, right? But you want to fill this with actual data when you have a conversation with the governments, right? So you do your best to enter the right information. So here, the Schedule K-1 Form 1065 beginning of the year, January 1st, 2021, ending December 1st, 2021, December 31st. This was a mistake. It should have been December 31st, all right? So part one, you put your company's EIN, your employer identification number, the address. So here we put the address. Again, everything is fictitious here. And here, what you want to put here is you want to put the IRS center where the partnership has to file the return. This will actually depend on your particular company and the states where your company is located in. And so I'm here with you, D. You want to check if this is a publicly traded partnership. If you are a PTP, you check that box. But in our case, this is not the case. Okay. And part two, so information about the partner. So part one was information about the partnership. Now we have information about the individual partner. So you put the partner's social security number or TIN. If the partner is not a U.S. citizen or green card holder, they have to have a TIN, a tax identification number. You put their info there. An F, you put the address where the partner lives. And G here, G does not apply to us. We put H1. So this partner is a domestic partner. The partner could have been a foreign partner or a limited partner or other LLC member. It really depends upon the situation. So you have to check the box that corresponds to your situation. Okay, and moving on here, we have the next one. The partner is an individual. Okay, I1 we put individual, and is this partner a retirement plan, whatever? No, we're not. So we haven't checked that box. So you can see that the first part is pretty straightforward. Okay, if the partner is a DE, a disregarded entity, such as a single member LLC that did not elect to be treated as a corporation, what will happen here is that the partnership will check the DE box and enter the name and TIN of this DE. Okay, so if the partner is not an individual, then you have to put the DE, the disregarded entities information. So that will be the name and the TIN. Moving on here, folks. Are you with me? All right. So here, I'm showing you on the screen, J, you have to put the partner's shares of profit, loss, and capital. This information is, there is a lot of calculation behind this information. I put it here, but I'm going to explain to you how we got the numbers. It's pretty interesting, and it's very easy as well. So here we put the profit 25%, loss 25%, and capital 25%. This has to be in your partner's agreement. It has to be in your operational agreement. It has to be written down, right? And the same thing here. So your beginning shares into your share of profit, loss, and capital at the beginning of the year and at the end of the year. So we saw that there has been a jump in partnership equity, if you will, equity share during the year. So we started at 25 and we ended at 40%. Moving on here, section K. So we have partners' share of liabilities. So we have non-recourse. I'll explain this later on. Don't worry about this. So we have non-recourse. We put 50,000 beginning. Non-recourse ending 60 grand. Qualified non-recourse financing 25,000 beginning, ending 30,000. And the recourse liability 25,000, ending 10,000. Now let's just quickly talk about it. So a partnership. Let's talk about non-recourse liabilities. A partnership liability is non-recourse if no partner or person related to the partner bears the economic risk of loss. Okay, so in the partnership context, a non-recourse liability is only paid in full out if there is a partnership's profitability. There are two types of debts. We have recourse and non-recourse. So a recourse debt holds the borrower personally liable. In other words, your ass is on the line. That's what it is. Like if I were to use a very informal language, this is what it is. You are bearing liability here. So all other debt is considered non-recourse. Okay, so a recourse debt holds the borrower personally liable, and all other debt is considered non-recourse. So in general, recourse debt loans allows lenders to collect what is owed for the debt, even after they have taken collateral, your home, your credit cards, right? Lenders have the right to garnish wages or levy accounts in order to collect what is owed. Very important. Continuing here. So on the screen here, we have section L. So the partner's capital account analysis. Beginning capital accounts, 1 million. Capital contributed during the year, 100,000. The current year net income, 150. And other decreases or increases, we put a decrease of 50 grand. And the ending capital account is 1.2 million. And section M, did the partner contribute property with a built-in gain? Loss? No. And the partner's share of net unrecognized, section 704C, gain or loss. The beginning, 5,000, ending 2,500. We can explain this on other shows. If you're interested, please drop us a comment, and we'll certainly actually do a show about some of those terms and phrases that may sound sort of complicated for you. Now, let's move on to, we are still on the screen, folks. We have lines L to N. I really want to explain this further. The reason is that it is important to understand that the beginning capital account and the ending capital account should be coming from your financial statements. Obviously, there are differences sometimes between tax financial statements and financial reporting statements. Sometimes you have what experts call deferred tax items because of those differences, and those differences are usually temporary. So we have deferred tax assets and deferred tax liabilities, but this is another topic for another day. What I want to say here is that, again, I'm talking about Section L, M, and N. So Section L, this data, the data here should come straight from your financial statements. And there are several financial statements that are involved here. For example, we have the statement of stockholders' equity. So this is the statement that actually talks about the equity movements in your partnership. So the data should come from there, part of it. So when we talk about capital contributed during the year, this should be actually directly tied to the statement of stockholders' equity. That's number one. We also have some movement on the balance sheet. Okay, here I'm speaking about purely accounting, financial accounting. And this is important because I want to show you that if you're having difficulty, let's just call it this way, if you're having difficulty finding the data, you have to go back to your financial statements, or you go to your accountants, or to your enrolled agents, or to your CPA, and he or she will gather the data and just help you fill this in. And so when we talk about current year net income, this touches your partnership's profit and loss statements. So the data there, the net income or loss, should come from the profit and loss statements. So when we talk about other increases and decreases, this depends. So depending on the increase or decrease, you will find the item on the balance sheet, on the statement of income, also called profit and loss statement, or the statement of owner's equity. Okay, and so the ending capital account should match what you put on the Schedule K-1 that you sent to the IRS. This should match what you have on your financial statements. Very important. Same thing when we talk about partner's share of net unrecognized, Section 704, gain or loss. Gains or losses are usually in the income statements, something you need to pay attention to. And so I'm here on Section N, okay? Section N. So you have to actually reconcile that data to what's in your financial statements. Section M, when it says, did the partner contribute property with a built-in gain or loss? If yes, here we put no, right? But if this were a possibility, this data should be found in the balance sheet because we have property. This is an asset. This is a long-term asset, depending on how long you're going to use the asset. The property is usually a long-term asset. So you have the balance sheet. You also have some movement on the income statement. I'll be right back right after this. Don't go anywhere. I want to talk to you now. Welcome back, folks, to another section of the Awesome Sweetie Kiwi Show. We are still having a conversation about Schedule K-1, 1065 line-by-line instructions. I want you to look right now on the screen. Do you see this? So here we are on Part 3, Partner's share of current year income, deductions, credit, and other items. So we're going to, so the ordinary business income or loss, we have a 375, and there are some items that do not apply to us. But again, folks, if this applies to you, please, you want to enter the info here. In our hypothetical example, we did not have anything from 2 all the way to 4C. We did have something for 5, interest income, all right. 6A, we have ordinary dividends, $10,000. 7, royalties, $1,000. Number 8, we have net short-term capital gain or loss, $5,000. Net long-term capital gain or loss, $2,500. In this case, we had a net long-term loss of $2,500. When we speak in accounting or taxation of capital gain, we are speaking about a transaction that covered more than 1 year. Okay, if the transaction covered less than 12 months, we're having something called short-term capital gain. Okay, so long-term is more than 1 year, short-term is less than 12 months. And we didn't have anything on 9B. 9C, we have unrecaptured Section 1250 gain. We covered this also on another show. And from on the second part of, I want you to look right now on the screen. Are you with me? Are you with me? All right. We have 9 distributions, $50,000. There was nothing else we have to include here. One thing I want to see here is that it really depends on, there are a lot of items here. We don't have time to cover each of them. But if you have questions, specific questions about your activity, you really want to pay attention to, and you can drop us a comment or you can email us. We'll certainly reply to you. One thing I want to say is that when we talk about income or losses, there is something called passive activity and at-risk rules. So the IRS considers something called passive income or non-passive. In other words, was the taxpayer a general or a limited partner in the entity, and his or her actual participation in the underlying partnership. We speak about materiality. So when the IRS says, have you materially contributed to the partnership's activities? In accounting or taxation, the word materiality means significance. So when the IRS says, have you materially participated? The agency is saying, have you substantially participated? Have you significantly participated? Was this activity an active source of income or a passive source of income? Moving on, we are here right now, line 7. I want to quickly go back to some of the items that we covered. If you look on the screen here, we are still on part 3. I want to cover section 7, royalties. I put here $1,000. I mean, we put, our team puts. So royalties, so the amount entered on this line will automatically flow to Schedule E, Form 1040, line 4. And we have line 8. Are you with me? Net short-term capital gain or loss. We put 5,000. So we had a net short-term capital gain of 5,000. And so the amounts that you actually report in box 8, they are not considered passive income. I've already told you about this. So amounts entered on this line will automatically flow to Schedule D, Form 1040. We have covered this on other shows. And line 9A, do you see this? Net long-term capital gain or loss, we had a loss of 2,500. So the amounts reported here are not considered passive income. Again, the amounts entered on this line will automatically flow to Schedule D, Form 1040, line 12. Very important. And moving on here, we have collectibles, 28% gain or loss. This is something that it really depends upon your business. We have none of that here, but if you enter any information here, collectible 28% rate gain or loss, this amounts will actually go to Schedule D, Form 1040, line 18. But you need to actually work your math through a 28% rate gain worksheet. There is a worksheet for that. We can cover that on another show, but for now, I'm just going to move on in the interest of time. And line 9C, we have unrecaptured Section 1250 gain. Here also, whatever you put here will flow to Schedule D, Form 1040, line 19. The bottom line here is that those items, whatever you put in part 3, will flow, most of them will flow to Schedule D, and this will be part of your 1040. Okay, so this is the partner's share of current year income, deductions, credits, and other items. So what the IRS is going to do is they are going to reconcile whatever you put here, whatever the company, the partnership put it on this form, and whatever you as an individual filed at the end of the year. Okay, so this is really important to make sure that there is similarity, actually not similarity, there is a match between the information you have here and the information you have on your Form 1040. It can be Schedule C, it can be Schedule D, it can be Schedule E. It really depends. Let's talk about Section 10. Are you with me? I want you to look right now on the screen. So we have a net gain or loss under Section 1231. Okay, and here, if the amount is a gain, it will automatically be reported on line 2 of Form 4797, sale of business property. So we really have to talk about this on another show, but I want to say that if the amount is a loss from a passive activity, that loss will automatically carry to the worksheet 3 of Form 8582 and is subject to the passive income limitations, something that you really need to pay attention to here. Moving on here, we have other income or loss. We put $5,000 here in our hypothetical Schedule K-1. So this can be anything, okay? So the one thing I want to say here is that this will actually happen if the partnership reports portfolio income other than interest, ordinary dividends, royalty, and capital gain or loss income. So the partnership should provide the taxpayer a statement informing the taxpayer of the type of portfolio income that's being reported. So normally when you have something in that category, other income, it has to be documented, it has to be backed up, it has to be substantiated, all right? So typically what we have seen in our research is that only real estate mortgage investment conduit, the REMICs, they will report income or loss on line 11A. So when the user opened this entry field, you will see that you'll have a lot of information that will actually help you report the right information. And we have, moving on here, folks, we have line 12. Line 12 we have here, section 179 deduction. And in our case here, we put down, and I'll basically talk about that later on. But I first wanted to talk about a few other things that are important that you need to pay attention to. So when we talk about other income, sometimes you might have involuntary conversions on that line. So this could be the net gain or loss from involuntary conversions due to casualty or theft. And this amount will not carry to any form or schedule in the program, not at all. And we also might have, in some cases, Section 1256 contracts and straddles. So the partnership will report any gain or loss from Section 1256 contracts on box 11. And sometimes you might have mining exploration cost recapture. Again, those are very exotic, quote unquote, specific sort of niche topics that do not apply to the general public. But again, we will be happy to talk about those if you have specific questions. If you have cancellation of debts, this could be considered also other income. Okay, the cancellation of debt amount is included in the taxpayer's gross income, and this amount will automatically be carried to Form 1040 Schedule 1, line 21. And thereafter, a taxpayer may actually elect to apply any portion of the cancellation of debt amount excluded from gross income to the reduction of the basis of depreciable property if the indebtedness was indebtedness other than qualified form indebtedness that is incurred or assumed in connection with real property used in a trade or business, or and is secured by real property. This is a little convoluted, but I do understand that this is important also. But again, we will be very happy to talk about this. If this applies to your particular situation, drop us a comment or send us an email, and we'll be happy to help you out. I want to talk to you about Section 179 deduction. This is a very important topic. So Section 179 of the U.S. Internal Revenue Code is actually an immediate expense rate deduction that business owners can take for purchases of depreciable business equipment instead of capitalizing and depreciating the asset over a period of time. Let me just explain to you in simple English. So when you buy an asset, when the partnership buys an asset, the partnership has two options. Either the partnership, of course, we are speaking about a capital asset. This is like in the PPE section of the balance sheet, when you have the property, plant, and equipment. The partnership has the option to capitalize the item. In other words, let's say you bought machinery for $50,000. You have the option to depreciate the machine over 5 years. So that will be a depreciation expense of $10,000 every year. That's option number one. Or you have the ability to expense the whole $50,000 immediately. That's what's called Section 179. Okay, and this is very important because Section 179 allows businesses to depreciate assets such as equipment, vehicles, and software. And this allows business to lower the current year tax liability instead of capitalizing an asset and depreciating over time in future tax years. And Section 179 is limited to a maximum deduction of $1,150,000 and a value of property purchased to $2,620,000 for the year 2021. So this numbers actually fluctuate, all right? And let's move on to line 13. So we have other deductions. So this is where you put a lot of stuff. It goes from cash contributions, 60%, cash contributions, 30%, non-cash contributions, 50%, non-cash contributions, 30%, capital gain property to a 50% organization, 30%, capital gain property, 20%. So this will basically depend on your situation. All right, here we are speaking about things that really relate to your partnership. On line 13, you might also put capital gain property, 20%, contributions, 100%. You have investment interest expense. You have deductions, royalty income, Section 59E2 expenditures. You have also deductions portfolio. You have amounts paid for medical insurance, educational assistance benefits, dependent care benefits, pre-productive period expenses, commercial revitalization deduction from rental real estate activities. You have pensions and IRAs, reforestation expense deduction, and Section 743B negative income adjustments. I'm just actually going through the whole list because I want to make sure that you can deduct as much as you can so that at the end you are able to reduce your tax liability. So here is the summary, folks. I want you to look on the screen, and I've showed this to you before at the beginning of this show. So if you enter everything correctly, this is what you would have. You would have screenshot number 1 and screenshot number 2. Thank you so much for your attention. I really appreciate it. I will see you next time. But until then, remember, stay marvelous.